Hi, Valerie Leonard here with Grinch Leonard Financial. And today we're going to be talking about the stock market. Are we going to see a continued rally into the year's end, or is the Grinch going to steal Christmas? Now, know that our team here at Grinch Leonard Financial is here for you. When you have questions about your investment strategy, if you're looking for professional money management, if you want to know how much investment risk you should be taking, if you're looking at retirement or funding any of your short-term or intermediate or long-term goals, we are here for you. So lean on us as you have questions. But let's start with taking a look at the stock market. We've had a bumpy quarter. This chart shows you a look at the S&P 500 going back 2 years. It shows you March lows of 2020 when we were at the peak of the pandemic. It shows you the strong trends that we've seen in place since that time. And then it also shows you the pullback that we saw in September. And then most recently that started with the Friday after Thanksgiving, and then the subsequent rebound that we've seen here in the last few days. So right now, when you look at the market, the trends are still very much positive, even though we've seen some volatility around the new COVID variant. We've had some comments from the Federal Reserve. We've definitely had a lot of question marks when it comes to risk, but ultimately, I think what we're seeing right now is investors are repositioning their portfolios for the coming year. They're also harvesting tax losses as they're looking at higher potential taxes. They're right now considering, okay, what do I need to do to minimize my income tax liability for the 2021 calendar year? So all of that has led to some selling, and ultimately, I think people are starting to get positioned for the new year, and that the positive trend will most likely continue to remain intact. Now, I mentioned this at my last in my last video, but it's very, very important, especially when we're looking at stock market volatility. So I wanted to raise this point again, that Guggenheim Investments published a study back in August, and they went back and they looked at all the major stock market declines going back to 1945. And what they found was that there were 84 cases where the market pulled back between 5 and 10%, but the average time for recovery for investors was only 1 month, which is a very short period of time. So up to a 10% correction can typically be followed by a very quick rebound. Now, there were 29 cases where the market pulled back between 10 and 20%, and the average time to recover for those pullbacks was 4 months. So you may remember the fourth quarter of 2018. This was an example where the market fell by around 20% and recovered very, very quickly. So I would argue, especially with the advent of technology and how fast markets trade these days, and how fast news travels, that up to a 20% correction can be a very normal event for your investment portfolio. And while it doesn't feel great, just know that historically the average time to recovery is about 4 months. Now, there's been 9 cases where the market has pulled back between 20 and 40%, with the average time to recovery being 14 months. So that's a much longer period. Doesn't feel good. You question your investment strategy. A lot of people want to take risk off the table when they're in the midst of a longer term period of pain. But for those investors with a longer term time horizon, you can know that, again, a 14-month pullback, is still a relatively short period of time over the life of an investment career. So just keep that in mind. But this is why we talk so much about risk management with more conservative investors, especially those of you that are in retirement. And we know that there's been 3 times where the market's pulled back by more than 40%, with the average time to recovery being 58 months. So those are very, very painful periods. And that's why we focus so much on managing the amount of risk that we are taking in our investors' accounts. So when you look at what's performed so far this year, through the end of last quarter, small cap value was the best performing investment category, followed by commodities, which were up about 21%, global real estate, large cap value companies, large cap growth companies, and then all the way at the bottom of the heap is the bond market. So that bottom right-hand corner, that orange box represents the bond market, which conservative investors have typically been able to go to count on for more conservative returns. Right now, more conservative investors are having a hard time with making money. And so an active investment strategy is very, very important. And then also understanding how the bond market affects the stock market is also an important piece of the equation, because the bond market is the largest and most liquid market in the world. So you've got to understand what's happening there in order to understand what's happening in the stock market as well. Now, let's talk about economic risk factors. If you think about risk from a green light, yellow light, red light analogy, I've tried to highlight some of the major things that are worth noting this month. Right now, the service sector is at historically high confidence levels. So we're giving that a green light. And we're actually starting to see the service sector rebound as people want to go back to concerts, as people want to have the experiences like travel that we haven't been able to have over the last 2 years. And so the service sector is positioned quite nicely going forward. And consumers are very confident. Americans, have taken a look back at the last year. They're looking forward to 2022, and consumer confidence is up nearly 18% since this time last year, which is a very positive sign because we are a consumer-driven economy. And as we go out and spend money, our economy grows. Now, the unemployment rate continues to be a yellow light. We're watching that closely, primarily because we don't have enough workers in this country. And when you don't have enough workers, that can certainly affect economic output. We saw baby boomers retire in record numbers in 2020, and we haven't fully replaced all of those workers we lost over that time period. And so that's something that we're watching closely. Americans have seen also a demographic shift where millennials have officially become the largest generation and overtaken the baby boomer generation. And millennials are now in their peak earning years, which means that they are making more money and they have the ability to contribute more to the economy, as opposed to the baby boomers who have been withdrawing money out of their investment portfolios and also consuming more. So that has been a positive shift, and we believe that's a green light for our economy as well. Recession risks, coming out of the recession that has followed the pandemic, we've seen lots of growth, but growth is starting to slow, and that's something we're watching closely, along with interest rates, because we believe rates will increase, and that will definitely mean that the cost of money, the cost of borrowing, is going to be higher for corporations and for Americans in general. Margin debt is also something that is worth watching because it's relatively high on a historical basis. Margin debt is the amount of borrowed money that is being invested into markets. And so when you have a lot of borrowed money in the system, that definitely creates additional risks. So the fact that it's relatively high is worth watching. But overall, the stock market trend, like I mentioned earlier, is still intact. And we feel like, even though we've tested certain levels recently with some of the pullbacks we've seen, things still look relatively healthy. We are watching the Omicron COVID variant. That definitely increases the chance of market volatility going forward. We're watching inflation. Now, this is something that I think is not always reported in the headline news. That's really quite interesting if you really think about it. I believe that inflation is peaking right now. I think in first and second quarters of next year, we're going to start to see the rate at which inflation has been growing start to moderate and start declining. So when you turn on the news, you hear that inflation is up. It's actually about 6.8% year over year, so since this time last year. But when you look at it over the last 2 years, inflation is up 7.48%, which averages out to be about 3.7% over the last 2 years. So when you look at average inflation over a longer term period, it's about 1.6, 1.7%. So we've definitely seen the cost of goods and services double over the last couple of years. But when you look at it over a longer term picture, it doesn't sound as bad as what it appears to be since just this time last year. We also think that supply chain issues are starting to work themselves out, and that in 2022, we'll see a lot of those issues resolve themselves. A lot of that will depend on the pandemic and the risk factors there. But overall, demand is still extremely strong, and that is extremely positive for our economy and for our market. As long as we are willing to go out there and spend money, as long as Americans are making more money, that's a good sign. And as a matter of fact, our debt levels when you look at it on a household basis, are at the lowest level that we've seen since the early 80s, since we started tracking the data. So consumers are healthy and they want to spend. So that's an update for December. If you have any questions, feel free to reach out to us. Again, like I said, our team is here, ready and willing to help. And in the meantime, I hope you guys have a very Merry Christmas, a Happy New Year, and we'll look forward to seeing you in January of 2022.